Hello, my awesome accounting students. Welcome back for the second half of chapter 23 on relevant costing. Today we'll cover sales mix, constraints, segment eliminations, and work on reviewing some other topics as well.
Okay, today, this is the handout that we looked over last time. I'm just going to go up to the top. We talked about a lot of different definitions. This is one of those chapters where I would spend a little bit of time going over the glossary to make sure that you are familiar with all of these different types of costs. We are working on utilizing relevant costs, relevant revenues, and relevant costs. Last time we were here, we took a look at some specific decisions, whether to accept a special order, whether to make or buy a part, whether to scrap or rework, whether to sell as is or process further. Today, now, we're going to talk about two major things. We're going to talk about sales mix considerations and eliminating a segment. So these are our two goals today, are to go through the sales mix strategies and eliminating a segment strategy. Any questions on where we've been or where we're headed? Okay, then here is our agenda. We've already recapped the various decisions. Today we're going to work on some more in-depth problems. There is a little section about keeping and repairing or replacing equipment. I don't think any of our exercises deal with that today. Our main focus is going to be on sales mix. And here's what that means. If a company sells more than one product, sometimes, let's say we sell 5 products, sometimes there are constraints built in.
Sometimes the constraints are internal. For example, we have a machine that will only run for so many hours, and sometimes they're external. For example, we may only be able to sell so many products in the marketplace. Before we hit the Excel exercises, I did like this slide in the PowerPoint presentation. It just summarizes what we looked over in the handout. It says when a company sells a variety of products, some are likely to be more profitable than others. So our goal for management is to look for the most profitable sales mix of products. If production facilities are limited, producing more of one product usually means producing less of others. In this case, and what this whole topic is about today, management must identify the most profitable combination, which your author refers to as the sales mix. And if there are constraints, then management will focus on the contribution margin per the unit of scarce resource. So a good summary of what we just talked about in the handout, I wanted to show you some examples that the author gives you. In this example, the company sells 2 models of scooters using the same machine. Pro uses 1 machine hour per unit, Max uses 2 machine hours per unit. We need to determine each product's contribution margin per machine hour. Again, the machine hour is the scarce resource. So you're used to calculating the contribution margin per unit. We covered that in the chapter on cost, volume, profit. The new part of this chapter is converting that contribution margin from per unit into the per scarce resource. In this case, the scarce resource is the machine. So we took that contribution margin per unit and we divided by the number of machine hours per unit. That gave us the contribution margin per machine hour. In this case, the Pro model has a much more profitable contribution margin when the scarce resource is viewed. In fact, it is 50% higher than the Max is. So we would focus all of our efforts on producing the Pros until some constraint ran out, whether it's the machine. And if that's the case, we would just produce as many of the Pros as we could, unless there was some other constraint that prevented us from maximizing out on the Pro. There could be a built-in customer constraint where a customer will only buy so many, there could be other constraints taking place. So I liked the decision rule here. Produce the model that uses the highest contribution margin per machine hour until the market demand is satisfied. And again, we would focus our efforts on the more profitable products. The first exercise on your Excel file is really a review of what we covered last time. So I'm going to flash the answer up there for you in a moment because I really want to get into a sales mix problem while the topic is fresh on our brains. So pause the video, go ahead and calculate your answer for whether they should scrap or rework, and then we'll dive into the sales mix. As you read the problem, I hope you noticed that the cost of $9,000 given in the first paragraph is a sunk cost. The cost has already been incurred. There's nothing we can do about it. We have some damaged telescopes, that's a fact. We want to look forward and consider the three alternatives given for these 50 telescopes. Number one was easy. Sold as scrap, just brings in $37.50. Done with that one. Number two, they could disassemble them at a cost of $2,000 and sell the parts to a recycler for $6,500. As you see on the screen, that brought in a net of $4,500. The third option was they can be reworked. That means continue processing them and turn them into good units. But the cost of reworking the units will be $3,600, but the units can be sold for $25,000. So on number three, you'll see that the net differential income from reworking them was $21,400. Since this is now money coming in, we're looking for the highest alternative, and that would clearly be the third option. So the decision to be made is we should rework and sell as good units. Let's move on to a sales mix problem, which is the major topic for today. Time for another sales mix problem. Chip Company produces 3 products, Ken, Ike, and Bix. Each product uses the same direct material. Ken uses 4 pounds, Ike uses 3 pounds, and Bix uses 6 pounds. I'm assuming based on what they told us, the direct materials are the scarce resource. Selling price per unit and variable costs are given in the table below. A says compute the contribution margin per pound. Okay, that's not a new concept. We know that the contribution margin is the difference between the sales price and the variable cost. So based on the information given to us in the author's table, I'm going to compute the contribution margin for each one of these by doing a simple subtraction. And 210 minus 144. Okay, that's not the new part. That goes back to chapter 18. The new part is if demand is limited, in other words, there's a scarcity, list the 3 products in the order in which management should produce and meet demand. What that means is we need to convert this contribution margin per unit into a contribution margin per pound of material, since that's the scarce resource. We do that by dividing by the number of pounds of direct materials that each one uses. They gave that to us in the first or second sentence up there. The first one uses 4 pounds, the second one uses 3 pounds, the last one uses 6 pounds. And so when we do the math on that, we will get the contribution margin per pound of direct material. And our goal will be to create or manufacture these products in a certain preference order. Let me label this contribution margin per pound of direct material. And we would make as many of these as we could first because it has the highest contribution margin. So that would be number 1. Then we would make as many of these as we could because that has the second highest contribution margin. And any materials we had left over, we would produce that middle product, the Ike. And that's a very easy example of a sales mix problem. On to the next one. Okay, let's try our first sales mix problem. Exercise on the screen says Colt Company produces 2 skateboard models. Machine time per unit for Hero is 2 hours and for Flip is 1 hour. Machine's capacity is 1,600 hours. There's an internal constraint. We have a machine that can only run 1,600 hours per year. So we'll want to make note of that when we determine the proper sales mix. Colt can sell up to 500 units of Hero and 900 units of Flip. Okay, there is an external constraint imposed upon us by our customers. So we'll have to keep that in mind. Selling prices and variable costs are shown. And for ease of understanding, I just copied the data here. It gave us the selling price, it gave us the variable cost, and they wanted us to do 3 things. They wanted us to compute the contribution margin. Notice this says per machine hour. That's the new part of this chapter. And they wanted us to determine the best sales mix. That's the goal of the second half of this chapter. And finally, they wanted us to compute the total contribution margin. If you go look at the steps and how to complete a sales mix problem, the first step was to compute the contribution margin per unit. That's not new. That's something that we've done in a previous chapter. So the contribution margin per unit is the difference between the selling price and the variable costs. So I'll highlight that so you can see it. So that's step 1. The information up top here was given to us in this chart. Step 2 is to convert the contribution margin per unit to the contribution margin per whatever the scarce resource is. In this case, it's machine hours. So I'm going to write the step down for us. Convert the contribution margin per unit to the contribution margin, in this case, per machine hour. How do you do that? You take the contribution margin per unit, which we just computed, and you divide by the machine hours needed per unit. Okay, so I'm going to go grab, let me get the names of the products. We have Hero here and Flip. I'm going to go grab the contribution margin per unit that we computed earlier. I'll put some color on there to show you where it came from. And then we want to divide by how many machine hours per unit each one takes. Okay, the author told us what that was. I'm searching for it right here. It's 2 hours for Hero and it's 1 hour for Flip. Okay, so when we take the contribution margin per unit and we divide it by the by the machine hours per unit, we'll end up with the contribution margin per machine hour. So let me go ahead and divide those 2 numbers. You can probably do that in your head. In this case, go ahead and do this one too. I could have copied my formula over. There's the contribution margin per machine hour. I'll put it in a different color so it stands out. What we want to do now is maximize on the more profitable of the 2 with the goal of optimizing the sales mix. Okay, how are we going to do that? There was a constraint here. There's actually a couple constraints. The machine's capacity is 1,600 hours per year, so that's how long the machine will run. And we also had that internal constraint saying that we could only sell up to 500 units of that most profitable product. So the goal is to sell as many of these as we can within the constraints given to us. And then once we've maxed out on Hero, we'll move over to the Flip. Okay, so we have 1,600 hours to deal with here. If we make as many as our customers will buy of the Hero, whoops, let me click that. Let's focus on the Hero. The maximum number of units that Hero would be able to be sold to our customers, they said, was 500 units. And if each one takes 2 hours of machine time or machine hours per unit, that means if we focus on the most profitable one, we would use up 1,000 machine hours. Okay, so what's our sales mix? We know that for Hero, it's 500 units. How do we know that? That's the maximum units that our customers would buy from us. Let's focus now on the fact that this machine's only going to run 600 hours. So how many hours were left for the second model? Okay, well, I'm going to put down here a little note. Let's do note 1. And I'll come down to the bottom, and for note 1, I'll notice that if I make 500 of the Heroes, I spent 1,000 machine hours. So then what is left for Flip would be the 1,000 hours taken up by Hero, subtracted from the 1,600 hours that the machine will run. So 600 hours are left for Flip. And if you want to leave a note on how you got that, that was the 1,600 maximum hours less the 1,000 used on Hero. That's how we came up with that. So if I have 600 hours left and each one takes 1 machine hour per unit, that means I can make 600 of these flip phones. So there is my optimal strategy. I'll call this letter B. It's actually part of this letter B. Okay, and finally, if we use that best sales mix, what is the total contribution margin for the best sales mix? In other words, we've decided right here what the optimal sales mix is. How much in contribution margin would that bring in? So we're going to call that contribution margin brought in with optimal mix. And we will take the sales mix units that we came up with. I'm going to grab those from the green up top, 500 and 600. And then we're going to turn that into dollars by multiplying by the contribution margin per unit. That is what we calculated in one of the first steps up here. 140 was the contribution margin per unit. 140. And so when we multiply that out, we get a total line in there, we will have the contribution margin that comes in with that optimal sales mix. 500 times 100 will give us 50,000. 600 times 40 will give us another 24,000. And when I add that up, probably do that in your head, but I'll let Excel do it. That gives us the answer that maximum sales mix that we just computed would result in $74,000 of contribution margin. That's our first sales mix problem. You may want to pause the video and try that again without the notes and see if you could come up with the same answer. That's an example of what the second half of the chapter is about. Let's go try another one. Let's talk about segment elimination. This decision usually comes into play when a department or a segment is showing a net loss. However, we need to be careful because sometimes an income statement prepared in a GAAP format doesn't help the manager decide whether the candidate is or should be a candidate for elimination. So what we need to consider is we need to consider eliminating it if their contribution margin is less than its avoidable fixed costs. So what we typically wind up doing is taking a look at the cost structure of the segment that's up for elimination and comparing the contribution margin to the avoidable cost will tell us whether a segment should be eliminated. So these definitions were covered fairly well by the author. Avoidable costs are amounts that are eliminated when the segment is eliminated. In other words, if the segment goes away, those costs go away. Unavoidable costs are amounts that would remain even if the segment was eliminated. Suresh Company reports the following segment or departmental income results for the year. You can see that there's 5 departments. My eyes immediately go to the last line, and the last line shows me that there are 1, 2, 3 departments with potential net losses. However, we know a better way to decide whether a segment should be eliminated. Letter A says if the company plans to eliminate departments that have sales, this top line item, less than avoidable costs, this second line item, which departments would be available? Okay, well, Department N has sales that are less than avoidable costs, and Department T has sales that are less than avoidable costs. So if we isolate those 2 departments, Departments N and T, and we take a look at those amounts, we would have $35,000 less avoidable expenses of $36,400 for N. We get rid of the decimals. I don't think we need those. It just takes up more space. And then in Department T, we'd have sales of $28,000 with avoidable expenses of $37,800. Let me compute that. I should have got rid of those decimals as well. The net loss, if these were eliminated, we would say goodbye to these amounts, and if we totaled them up, at least that net loss line, let's total that up. If we were eliminated, if these 2 departments were eliminated, we would save $11,200 of losses. Let's take a deeper look at segment elimination before doing the next exercise. When a segment of a business is performing poorly, management must consider eliminating it. Segments with contribution margins less than avoidable fixed costs are the candidates for elimination. As the slide reminds us, avoidable costs are eliminated when the segment goes away. They include all the variable costs and direct fixed costs such as rent on that segment's space and insurance on that segment's eliminated equipment. The unavoidable costs, however, remain even if the segment is eliminated. These costs typically are allocated to remaining segments when a segment is eliminated. In this example from your text, Fast Track reports results for 3 segments as you see on the screen. Total income is $95,000. However, that treadmill segment shows a $10,000 loss. Management is considering eliminating the treadmill segment. We need to be careful as some segment costs might be unavoidable even if the segment goes away. Remember what we will use to make the final decision. A segment should be eliminated if income increases from elimination. It should continue if income decreases from elimination. Let's take a look at how that might look. Eliminating the treadmill division would eliminate its sales, variable costs, and contribution margin. We need to take a look at the fixed costs. If we knew that the $15,000 in fixed costs consists of $4,000 in avoidable costs and $11,000 in unavoidable costs, then we would be able to make a wise decision. The $11,000 in unavoidable costs would be reallocated to wellness and fitness. The revised results are shown above. We see that if the treadmill segment is eliminated, total income would actually decrease by 1,000 from 95,000 to 94,000. This means the treadmill segment should continue. The same decision is made using the segment elimination analysis as you show on the screen. The continue column shows treadmill's results for the current period. The eliminate column shows what items remain after the segment is eliminated. We see 0 for sales, 0 for variable costs, and the contribution margin will then disappear if the segment's eliminated. The eliminate column does show 11,000 of fixed costs that are unavoidable even if the segment is eliminated. The income decrease column shows the difference between the two net incomes. No matter how you look at it, given that the previous income with the segment was $95,000 shown on the previous slide, and the net income without the segment drops to $94,000, the company would be better off if they continued the segment. They would be saving, as shown on the bottom analysis, $1,000. Okay, let's do an example of a segment elimination. It says that Marin Company makes several products, including canoes. The company reports a loss in its canoe segment, as you see in the statement below. Then the author goes on to tell you that all the variable costs are avoidable. So 300,000 of the fixed costs are avoidable. So compute the income increase or decrease from eliminating this segment, and then they ask you a follow-up question: should the segment be eliminated? Well, if they eliminate the segment, they would have 0 sales, and since they mentioned that all the variable costs are avoidable, you'd also have 0 in variable costs, which would give you a 0 contribution margin. And then they mentioned that 300 of their fixed costs are avoidable. That means if they eliminate the segment, they can get rid of $300,000 of fixed costs. Well, looking at the fact that now 340,000 fixed costs exist, that means that 40,000 of the fixed cost would still continue to be what they say unavoidable. So looking at that quick income statement, the contribution margin of 0 minus 40,000 in fixed costs would give us a net income, or a net loss in this case, equal to a negative 40,000. Let me let the computer calculate that. So right now, the net loss with the segment is minus 60. The net loss if the segment was eliminated would be a net loss of 40,000. So the segment should be eliminated, as it would result in a $20,000 cost savings. That would be the difference between these two net losses. On to the next one. Let's talk about setting normal prices. Pricing decisions are one of the most important decisions that managers can make. They are also sometimes one of the most difficult decisions. Managers always need to consider outside or external factors involving supply and demand and apply them to a product or a service pricing. It's important for managers to understand the setting in which they set prices. As you'll see on the screen, companies can be price takers or price setters. Most of them fall somewhere in between this spectrum. The graphic that you see reflects this range and the characteristics of companies at the extreme. Price setters have more control over setting prices, whereas price takers have less control. Total cost methods are often used by companies that are price setters. That means there's weak competition, the product is somewhat unique or branded, and there's high barriers to entries. These companies can use a cost plus approach. On the other side of the spectrum, when competition is high, companies might be forced to be price takers and have little control in setting prices. In such cases, target costing or target pricing can be useful. This approach is almost where you work backwards from a given market set price, take off your target profit, and wind up with a target cost to which you need to make sure that your operations can efficiently be used to fall below this target. Somewhere in between is the variable cost method. Your book does a very good job of describing these approaches. Now let's try an exercise to cement the concepts. Let's give this exercise a shot. We'll be using the total cost concept, which is often used by price setters. It says school company makes snowboards and uses the total cost method. Its cost for producing 10,000 units follow. The company wants a 12.5% markup. So they give you the variable costs, they give you the fixed costs, and they ask you to compute the total cost, the markup, and the selling price. Go ahead and give it a shot, and I'll be back with the answer. Here's the answer. Check it out. I set mine up with showing variable costs first, fixed costs second, adding them up on both a total and per unit basis, and I came up with a target selling price of $270. If you came up with the same thing, it looks like you're on the right track. If not, take a look at my answer, compare it to yours, and as always, reach out for help if you can't resolve any differences. Okay, here is a special offer pricing. What we need to remember about special offer pricing is there should be capacity left to produce these. Once again, if we could sell all of our units at the normal selling price, then we wouldn't be entertaining any type of special offer. So keep that in mind. Let's read it. It says, Faro Company reports the following annual results. The company receives a special offer for 15,000 units at $12 per unit. Well, there's our revenues. So I'm going to come over here, and as I read, I'll go ahead and fill this little income statement in. 15,000 units at $12 a unit. If I, $12 a unit, that would be my differential revenue coming in if I decided to accept it. Now I need to take a look at my incremental costs, which will be any variable costs associated with producing the units, as well as any type of incremental fixed costs. So that's what we're looking for here. It says the additional sales would not affect its normal sales. Variable cost per unit would be the same for the special offer as they are for the normal units. Okay, they just got done telling us about variable costs. So I'm going to go ahead and take a look at those now. I see that I would incur direct materials, direct labor, and variable overhead. And they gave us the per unit amounts, $2, $4, and $2.50. I'll go ahead and add those up because those definitely would be differential costs. Add those up. And then to get my total variable costs, I would multiply that out by the number of units. I believe that was 15,000. So there would be our variable cost. Now let's take a look at our fixed costs. We're going to have to read carefully because typically fixed costs are fixed over the long term unless the author tells you about any special incremental fixed costs. So going back here, it says the special offer would require incremental fixed overhead of 60,000. So I will put fixed overhead. That would be incremental. That means if we accept this offer, those fixed costs would go up by 60,000. And if we didn't accept the offer, we wouldn't incur those fixed costs. Make this wider so you can see it. In addition, in that same part of the sentence, it said there would be incremental fixed general and administrative expenses of $4,500. So I'll call that fixed G&A. We'll go ahead and add those up. Let me put a total line in here. Let's go ahead and sum up those incremental fixed costs, which are unique to this special offer. And now we are in a position to make our decision. As soon as I add up all of those costs, which I will do right here, that would be a sum of the variable and fixed costs. And I can see that if I make this order, I would bring in $180,000 of revenue, and it would cost me $192,000. So my differential net income actually would be a loss. And in this case, because we are not even covering our costs by making this special item, we would make the decision to reject. As a final wrap up to the chapter, let's attempt one more sales mix strategy that may have some constraints built into it. Some company produces 2 models of its products with the same machine. The machine has a capacity of 200 hours a month. Okay, there's our first constraint. A machine can't run nonstop. It can only run 200 hours per month. They gave us the contribution margin per unit. They told us how many machine hours each unit takes to make. What we need to do is convert the contribution margin per unit into a contribution margin per machine hour. In addition to that, we also have some external constraints placed upon us from our customers. One item, the standard product, can only be sold up to 550 units. That's all our customers apparently are willing to buy. In the Pro model, we can only sell 175 units. So if you look at the requirements, as I mentioned, you're going to convert that contribution margin per unit to a contribution margin per machine hour, as number 1 asks you to do. You're going to get the maximum sales mix as well as the contribution margin that sales mix would bring in. And then they did a what if scenario on number 3. They changed the maximum demand and they asked you to once again compute the best sales mix. Since this is a review, I'm going to let you attempt this one and we'll come back and compare answers. Pause the video, give it a shot, and then we'll come back and take a look at how you solved it. Let's check it out. First of all, I just copied over the data to come up with the regular contribution margin. And let me change that to say per unit. Sorry for the bouncing screen. Per unit. That was given to us. So step 1 was to convert that to a contribution margin per machine hour. The way you do that is by taking the contribution margin per unit and dividing by how many machine hours each unit takes. We see that the standard product is the more profitable of the two, so we would max out based on how many units we could complete with the constraint on the machine hours. And we noticed that all 200 hours should be devoted to the more profitable model. Since each one of those standard models takes 1 hour to complete, we would make 200 units. Okay, and none of the second product. When they switched up the constraint change on you, that changed our most optimal sales mix because the customer demand was only at 180 units. So we used up 180 machine hours. That means we had 20 hours left to use. Since each of the second model takes 2 hours to compute, we would only be able to make 10 of those. The thing I didn't answer here was how much contribution margin that would bring in. The contribution margin from that optimal sales mix would be the 180 units of the first product at $40 and 10 units of the second product, the Pro model, at $50 a unit. When we add that up, we would have our total contribution margin from the most profitable sales mix under the second set of constraints. In summary, this chapter covered a broad range of topics centered around your ability to identify relevant revenues and costs or expenses and to use them to make proper managerial decisions. In summary, we talked about the decision-making process itself. We learned about all the various types of relevant and irrelevant costs, and there were quite a few of those that fell under that umbrella. We then went on to learn about production decisions. These included such things as make or buy, whether to sell or process further, whether to scrap or rework. We also took a look at sales mix strategies with both internal and external constraints. We then moved on and talked about some capacity decisions. One of them that we spent quite a bit of time on was segment elimination, and another one was whether to keep or replace a machine. After that, we followed up with a discussion on normal or longer-term pricing. We talked about the difference between price setters and price takers, and we looked at pricing strategies for either end of the spectrum, and we took some middle-of-the-road approaches as well. Finally, we covered special pricing or more shorter-term pricing decisions that often were for a one-time special deal. Lots of things were covered in this chapter. Use the time wisely in studying and working through as many examples as you possibly can fit into your study schedule. As always, reach out for help if you need it. This is Professor Johnson signing out.